So a lot of people are searching for the holy grail system. Why do traders jump from system to system?
They jump from system to system because people react or tend to react to pain much more than gain. And I'll give you an example of that when I personally saw and experienced. So 2005 was a great year for trend following. That was after 2004, which is a bit miserable. And this trend following desk started out with actually a very low capital allocation. And they made money, and good money. And so senior management said, that's fantastic, let's really increase their capital allocation. 2006 wasn't that good. So they, after the losses of May 2006, when the markets were a bit wobbly, they decreased the capital. And then this desk continued trading until the end of 2006. Now, what ultimately happened, the second half of 2006 was actually quite good for trend following. So they made money. So, okay, so I just said they made money at the beginning, lost money in the middle, and made money again in the beginning. So on a percentage basis, the equity curve was like this, and then ultimately positive. On a capital basis, in terms of actual dollars and cents earned, they had lost money. Because they lost money when they had a lot of capital and made money when they had very little capital. So it's this fact that people can't see the long term that ultimately really is detrimental to their trading behavior. And there's a reason for that. See, somehow, even though we don't voice it all the time, we're afraid of death, and we know that our life is finite. So it's therefore very difficult for somebody to show you the S&P, and you can construct some synthetic version of it going all the way back over the last 180 years. And if you actually look at the S&P over the last 180 years, it literally does this on the log scale, goes up in a straight line. Even 2008, 1929, they're just blips. It just did this, boom. So you say, you know what, I should just buy and hold or just pile money into the S&P. Yes, over a 200-year period, that's fantastic, but find yourself in the middle of 2008 having to wait between 2008 and 2013-14 for it to reach back again. What do you do for those 5-6 years? So it's the finiteness of our life and the fact that we just can't take pain that people tend to hop like crazy.
How do you know if you've got a winning strategy if you don't win all the time?
Again, certainty and not being able to take pain for a long amount of time. Ultimately, a strategy can only be determined by its historical performance. So if you have a lot of data, several years, preferably during different market regimes, you know how it behaves, the first question to ask yourself is the loss I think it's incurring right now comparable to previous losses? If the answer is yes, I shouldn't touch it. So let's say I have a trend following strategy, and does this thing lose 50% from time to time? Yes, I'm down 30% right now. I've been there. Okay, I might have been there in back testing, not in real life, but I believe in this and I've been there. So therefore, don't touch it. But if the kind of loss I'm seeing right now and the speed with which it's losing and the market conditions are not at all reflected at all in the testing I've done, I'm encountering new territory. So then the first question to ask is not the system good or not? What kind of loss am I willing to incur, switch everything off, and start at a later point in time? So it's interesting, there's always this kind of meta view on what you're doing. It's not just about the system, it's also about ultimately how much am I really willing to lose. And that is usually the override switch.